So our second axiom is, starting sooner is better than starting later. And don't forget its accompanying corollaries. If you can't start early, start now. And if you've already started but you need to save more, start saving more.
Axiom 3. Time in the market is better than timing the market.
What Axiom 3 tells us is that when we invest our money in the stock market, doesn't matter as much as how long we keep our money in the market. Or put another way, even if you invest your money at the absolute worst time based on the market's performance, you're probably still better off in the long run than if you hadn't invested your money at all. Let's look at an example.
Let's say that two investors were given $5,000 a year to invest in a portfolio of stocks. One investor, Unlucky Bob, always chooses the exact worst day of the year to invest in his stock portfolio. And the other investor, Lucky Jane, always chooses the exact best day to invest in her stock portfolio.
The worst day of the year to invest is the day when the market is at its high, meaning that stocks are at their highest prices. This is actually the best time to sell stock, not buy stock. Comparatively, the best day of the year to invest is the day when stocks are at their lowest prices. Of course, it's impossible to know this information at the time because the stock market is unpredictable from day to day, but it is possible to chart this information retrospectively.
For the sake of this example, we'll say that Bob and Jane's stock portfolios performed equivalent to the Standard & Poor's 500 Common Stock Index. The S&P 500 is a market value weighted index of stocks that is the most widely used performance benchmark against which portfolio performance is measured.
Here are the days that Unlucky Bob chose to invest his money. Coincidentally, these are also the days when the market was at its highest, as measured by the S&P 500 index. So, December 16th, 1985, December 2nd, 1986, August 25th, 1987, and so on, were all the actual market highs for each year in the 10-year period from 1985 to 1994.
On the other hand, here are the days that Lucky Jane chose to invest her money. It also just so happens that each day she picked to invest her $5,000 was the market low, as measured by the S&P 500 index. So, January 4th, 1985, January 22nd, 1986, October 19th, 1987, and so on, as you see here, were the actual market lows for each year represented.
Remember, each of our investors was given $5,000 to invest each year over a 10-year time period, giving each a total investment of $50,000. Now, let's go back and actually run these numbers based on the market's performance over this time frame.
One might think that since Unlucky Bob is so unlucky, he probably lost money based on his poor timing of the market. In fact, it was impossible to have worse timing than Unlucky Bob. But surprisingly enough, over this 10-year period, Bob racked up a total of $81,393. Not only did he not lose money, he saw a return of his investment for over $30,000.
Now, let's see how Lucky Jane did. If Unlucky Bob did so well, she must have really blown the lid off the market with her impeccable timing. What was her total? A hefty $103,452 after the 10-year period. A return investment of a little more than $50,000.
So, Jane did quite a bit better than Bob, but not that much better based on their polar opposite approaches. So actually, neither Bob nor Jane were that unlucky. They both made a nice bit of change on their investments due to their consistent investment strategy over time. And they both did much better than they would have done keeping their money in a savings account or CDs.
What's the moral of their stories? Why, it's the old axiom. Time in the market is more important than timing the market. And that's our third and final axiom in our three-part savings strategy.
As you begin to develop your savings strategy, some factors you should consider are: how much is it possible for you to save? How much do you need to save to meet your goals? Are you willing to get a second job if that's what it takes to meet your goals? How long do you have to achieve your goal? Would you rather retire later in life than save more today?
These are tough choices to make, but remember, saving money takes discipline. As you contemplate these decisions, here's a neat little rule of thumb for you to play with. It's called the Rule of 72.
The Rule of 72 is simply a mathematical ratio that tells you how long it'll take you to double your money with a particular investment, based on the return rate you expect to achieve. To use it, you just divide the return rate into the magic number 72, and the answer you get is the number of years it'll take you to double your money at that rate. Here's an example.
Suppose Pa Rickenbacker has invested heavily in pork bellies. If pork bellies are doing well and paying at a return of 20%, then we divide 72 by 20 to find that Pa will double his money in 3.6 years. If pork bellies do poorly and pay a return of 5%, then we divide 72 by 5 and find that Pa Rickenbacker will double his money in 14.4 years.
Now, the rule of 72 is just a rule of thumb so that you can gauge how quickly your investments will pay off over time. Now, the rule presupposes that you'll be making a constant return over time, something that is usually not true. Most returns on investments fluctuate, so the rule is designed to give you only an approximation on your investment choices based on your time horizon.
If you are at a loss as to how to begin a consistent savings and investment strategy, one great approach is to take something called dollar cost averaging. This strategy may help you choose the highs and lows of the market to your advantage. Let's look at how it works.
Dollar cost averaging is a strategy designed to buy more stock when the market is down and less stock when the market is up. The key here is to put a set amount of money into the market at regular intervals, like once a month. By doing so, you will automatically purchase more shares when prices are low and less shares when prices are high.
Here are some numbers to show you what we mean. Suppose you invest $200 in a particular stock each month. Let's say the first month the share price is $10. So your $200 would buy you 20 shares. The next month, the market dips and the price for your stock goes to $5 a share. This month, your $200 buys you 40 shares. In the third month, the market pops back up to $10 a share. Again, your $200 brings in 20 shares.
See how our strategy has benefited us? Over these 3 months, we have spent a total of $600 and purchased 80 shares of stock. During this time, the average stock price was $8.3. Because of our dollar cost averaging strategy, our average stock cost was $600 divided by 80 shares, which comes out to $7.5 a share. This may not seem like a lot of savings, but over time and with higher dollar amounts, the difference is significant.
Keep in mind that market volatility helps dollar cost averaging work, but the strategy doesn't work in our example under the following 2 circumstances.
1, if you were able to buy all your shares at $5, you would have been better off. And 2, if you bought some shares initially at $10 and the stock went up from that point, never returning to under $10, you would have been better off buying all your shares at $10.
As you can see, dollar cost averaging works best in a volatile market because the highs and lows of the market don't affect you as much when you use this strategy. In addition to possibly saving you money on average share price, there are 2 main advantages to using dollar cost averaging.
1. Dollar cost averaging creates discipline in investors and prevents them from becoming market timers. And 2, during a volatile market, dollar cost averaging allows investors to purchase more shares when prices are low.
However, dollar cost averaging does not always return a profit and does not protect against losses in a declining market. In addition, since dollar cost averaging involves continuous investment in securities, regardless of fluctuating price levels, investors should consider their financial ability to continue their purchases through periods of low price levels.
So that's dollar cost averaging for you. It's a great strategy to use, whether you're just starting out in the market or whether you're an old pro. It will allow you to create a systematic approach to investing that takes advantage of downswings in the market.
One last thing to remember before we move on. You generally have more control over how much you save each year than how much your investments will earn. Some people make the mistake of relying on extraordinary investment returns to make up for their lack of a long-term saving strategy. But before you do anything, sit tight and watch this next section on the 6th step designed to help you take control of your financial future, investing.